The Money Show.
Personal Finance with Warren Ingram.
Warren Ingram, of course, is a certified financial planner at Galileo Capital. How's it, Warren? Good to talk to you. Talking tonight about how to maximize your investment growth. I presume here we're talking about long-term strategy.
Exactly right, Stephen. I think, a lot of the time when we talk about investing and we talk to people about investing, they will be raving about the great return they had on whatever the investment flavor of the month is. The share that doubled in value over the last year, or the crypto coin, or whatever it is that did well. But you find when you speak to those people, 2 or 3 years later, very often the conversation's gone rather muted. Whatever that star performer was hasn't done so well, and often given back a lot of the growth that it had generated over a very short period of time. And I think when you speak to people who are not that familiar with investments, they're often quite cynical about markets and about investment growth, because they believe it's the system doesn't work for them. This investment thing works for some people, but surely not for them. And I think you're right. It's because there is a big lack of long-term focus on how you build money. I think you build money very much like I guess the pyramids would have been built. I wasn't there, so I don't know, but I think it was done one block at a time, one day at a time, 1 week at a time. And you can build phenomenal buildings, and you can build really good wealth, but you do it day by day, brick by brick, with a huge long-term focus. And you really have to forget about what's going to happen from day to day. I mean, we don't even know what Trump is going to say tomorrow, and focusing on that as a way of making money is just not sensible.
Okay, you talk about aiming for a balance between reward and risk. And I just know, because I know you, Warren, that you're going to start off with diversification here. So true. We when we look at investments and you ask someone, how much growth would you like? They would say to you, okay, I'd like to double my money every 3 years. I'm a reasonable person. Surely that's not a difficult target. And if that's a target, I would probably gulp if someone says that to me. But the next thing to ask them is, if that's your target, are you prepared to live with an investment that goes down by 60 or 70% over a 12-month period? Because if you're aiming for something that's going to double every 3 years, and almost nothing in the world will do that consistently, I promise you that. But if that's your goal, then it means you need to be prepared to lose more than half of your money over a 12-month period. And that starting point is critical for investors to understand. If you're just going for maximum risk all the time, maximum growth, that's fine. It's a bit like saying, well, I'm going to build a racing car, and I'm going to put no brakes on it, no suspension, and nothing that makes it go around corners or slows down. I'm just going to make sure it goes as fast as possible. And I think we all know how that story is going to end. And so getting that balance between the growth that you would like, so the reward, and the risk that you need to take to get that reward, starts with making sure you've got the right combination of cash, bonds, property, shares, and that you've got a good combination of different geographies. You can't just invest all your money in the US, for example, because you think that that's the home of the new big tech businesses that will take over the AI world. The reality is that they might do that, but at the same time, there might be some great biotech companies sitting in Korea, and some phenomenal industrial businesses sitting in India, and possibly still some good companies left in the UK. I don't know of any, but there might be, and then all through Europe. And so you need to have a good spread of companies and countries and investments to make sure you get that spread between risk and reward correct. You also obviously need to, have proper asset allocation. So you need to look at different asset classes. I mean, what basis do you judge them, or assess them rather?
Your time frame here is your absolute ally in this decision. So if you're going to invest money for a 3-year period, because that's what you need to do to save money to get a deposit on a house, you absolutely can't go in and put that money into the stock market, even if it's a beautifully diversified index or a diversified global equity unit trust or anything like that. And the reason is simple, that the stock market's a great place for long-term growth. What you need to do when you've got a very short period of time, and 1 to 3 years is a short period, and you've got a finite goal. In other words, you need to have whatever it is, R1 million,
in 3 years' time for a deposit on a house, then you can't afford to lose any money in a stock market correction. So your asset allocation, and really that's that combination of cash, bonds, property, and shares. That decision is largely determined by how long you need to invest that money for. And then secondly, your psychological tolerance for risk. Are you going to freak out if you see your investments go down by 5% over a year? Because if you are going to freak out, then that means you can't have too much in shares. And then the last factor will be your financial ability to deal with risk. If you're investing some money and you've got resources in emergency funds, you've got access to other money if you need it, that means you've got the capacity to take a lot of risk. And those are the three kind of broad factors that you would use to determine your asset allocation. But critically, your time horizon, I think, is the one factor that overrides everything. Longer term, you can afford more risk. Shorter term, you need to take the risk off the table and be much more cautious with your investments.
How often do you need to look at this? I mean, there's another word, rebalancing. How often do you need to do that?
I would feel comfortable doing that in every year. I don't think you need to do it more frequently. And I think if you do it too infrequently, let's say you only do it every 5 years, there's a very good chance that the very strong growing assets that you've got in your portfolio might have moved the whole mix of assets completely out of line. In other words, you could have far too much exposed to shares, far too little in bonds, property companies, and cash. And that might not be a bad thing when your shares are doing well. But if you're trying to manage the risk as well, then chasing the returns, in other words, letting those shares become too big in your portfolio, means that you're setting yourself up for a disaster when the stock market does take a hiding. And we don't know if that's going to happen tomorrow or in 7 years' time. And so because we don't know, and no one does, making sure that the mix of your assets is correct at least once a year, and maybe do it at the same month every year, is probably sufficient to make sure that you've got the right spread of assets, Stephen.
I mean, also when you do this, you've got to really kind of, I suppose, smell the wind a little bit. But you shouldn't just react quickly. You need to sort of make sure you stick to your timetable. You don't suddenly, because you don't like this, get out of that. You've got to think about it quite carefully and quite soberly and give yourself some time for it.
I agree 100%. And I think also resist the urge of FOMO, the fear of missing out, because I think we need to know that, what we get told, whether it's in social media or by our friends, about how investments work or what's doing well or what people think is going to do well, and potentially also what they think is going to be a disaster. All of those are simple opinions, and they might be very eloquently positioned, and it might be an incredibly intelligent person who's extremely well read and knowledgeable giving you an opinion, but they are forecasting. In other words, they're trying to predict the weather. It's as reliable as that. We can come up with very eloquent arguments about why AI-driven shares will be amazing in a decade's time, and equally, we could say that they're all overpriced and they're all going to fall over, and there'll be a bunch of other new companies that will do much better. The truth is we don't know. So don't get too distracted. Build your portfolio and your asset mix and your objectives around yourself and what you need to do, and then don't worry too much about what everyone else is telling you they're doing and what the world tells you to do with your money. They don't need to live with the consequences if it doesn't go well.
Controlling your costs, because I mean, sometimes investing this can be, well, there is a cost to it. It shouldn't be that expensive. But sometimes people will also talk about sort of free investments.
Yeah, I think we've seen in the last while, two very well-known platforms in South Africa significantly bumping up their fees, and they had built themselves a reputation on being extremely low cost, and some of us were wondering how on earth they would be able to survive as businesses with the cost that they were charging, and surprise, surprise, the costs have gone up, and so I think understanding that if you're going to choose high quality investments, and by high quality I don't just mean what it buys, but also is there a good administration, is there good risk control from a fraud protection point of view, do you get proper tax statements and proper reports and access to your information. All of those things characterize high quality investments. And if that is the case and you want to buy high quality investments, make peace with the fact that they will carry some costs. And I think some costs are reasonable. You want to know that if you're making a long-term investment, that it's going to be around in a decade or two when you need the money. And so you don't want a nasty surprise where suddenly your costs jump up by 50%, or that the company ends because it wasn't ever sustainable. So I think be careful of very low cost or free investments. Sometimes a free investment could be a scam. Yeah, and that's something you've got to be careful of. And so if someone says to you, this is a high quality investment and it's free, you need to ask some serious questions, because it probably means you just don't understand what the costs are. So I think be happy to pay some fees. It provides longevity to your investments, but surely don't go and buy things that cost you 3 or 4% a year. That's ridiculous, and it's destroying the potential growth of your long-term future capital.
You've got to look at tax. I mean, you do have tax implications. You're getting an income, you're getting money from these investments. How do you manage that?
I think it's being careful that you don't overly focus on tax first. So not one of us ever wants to pay more tax than we have to, and certainly it's our constitutional right to pay the maximum that we must, but also the minimum we're allowed. And so make sure that you are tax efficient with your investments, but you don't want to get an over focus on saving tax. In other words, someone comes to you and says, "Here's this new structure. It's going to last for 5 years. You're going to pay me 5% a year because I'm the person putting it together for you, but gee, you're never going to pay tax on that." That's no good. What you're doing is paying some product pusher a huge amount of money to sell you a very tax efficient investment that's probably going to generate no growth. And if you don't want to pay tax on an investment that that doesn't generate growth, why don't you just go to the casino? It gives you the same job. So you don't want to avoid tax if you're in a position where you can actually generate good growth and pay some tax. That's okay. But I think a lot of people, especially older people, as they get later on in life, they start fixating on estate duty, for example, and then they start making really silly investment decisions because they want to avoid estate duty, and potentially end up leaving their beneficiaries a lot less money than they could have. And so I think be careful of that. The tax efficient vehicles that are really good for us, that are healthy, are tax-free savings accounts and low-cost retirement funds. Those are good ways to save and avoid tax, but be careful of structures that are complex, that lock you in and charge you high fees. Those are just a waste of your time.
We're speaking to Warren Ingram tonight, of course, co-founder at Galileo Capital in personal finance. We have a question for you, Warren. It comes from Kim. Kim says, I'm in my 60s. I have some extra savings I won't need in my lifetime. Both of my adult children have recently bought homes. They've got young children at school. Is it a good idea to give them some of my money now? I do want to help them, but I don't want to run out of money myself. And I think there are people in this position. Is it an early inheritance? What if you then need it? Becomes the question. Well, we'll have the view from Warren in just a moment. Also, your questions for Warren on 011 883 0702 and 021 446 0567.
The Money Show.
Personal Finance with Warren Ingram.
Warren, we're going to get to Kim's question in a moment. First, we have Anne on the line from Sandton. Anne, hi. You have a question about retirement money in an RA, I presume a retirement annuity. Anne, good evening. Go for it.
Good evening. Thank you very much. Yes, I was persuaded. I had 800,000 rand left to live on until the end of my life. And I was persuaded to put it into an annuity with Liberty Life, which gives me approximately 8,500 rand a month for the rest of my life. Was this a good thing to do?
It's an interesting question, and thank you, Warren. Was it a good thing to do?
It's a tricky one, and I think understanding that when you've got very limited money left, and you can use the remaining money to buy an annuity. They're usually called life annuities or compulsory annuities, where it at least guarantees that you get some kind of an income for the balance of your life, especially if there is an element of inflation growth in that every year. So they'll give you a bit of an increase. Then very often, that can be a good call. The trick there is to make sure that you're getting a very good deal. And often people who one of the things that the insurance companies will do is that they will ask you a whole bunch of health questions. And if it seems like you're going to live for a very long time, then guess what? They're going to give you a lower income. If you're not healthy or you don't have longevity in your family history, then they might actually give you a higher income. And then your job is to live as long as possible because you win. So I think looking at these life annuities, if you've got a very small amount of money left in your retirement funds, it is certainly worthwhile, especially when interest rates are high. But gee, you've got to do your homework very carefully. I don't think it's a one size fits all answer, Stephen.
Yeah, and not an easy situation, I'm afraid, for you.
Can I ask a question?
Yeah.
I was given a flat rate on 800,000 Rand a month of 8,500. A flat rate of 800,000 Rand. I'm getting 8,500 Rand every month.
Yeah.
There was no question about my health or anything. Somebody did it for me, and I am not existing on,
I'm sure,
8,500 Rand a month.
All right, Anne, thank you. Obviously, Warren, I mean, there'll need to be a lot more investigation into all of this, but it's also a reminder of how careful you need to be with these policies.
Yeah, and I think it's a very the very difficult thing there is no inflation protection. So if it was, I just wanted to check, Anne, was it 8,500 a month?
Anne's gone, but I am presuming that was the case. She was receiving 8,500 Rand a month on an investment of 800,000 Rand.
So just to give you an idea, Stephen, that was that works out at just under 13% a year. As an income on that amount of capital. So if you take that 8,500, you times it by 12, and you make that a percentage of the 800,000, it works out at 12.75, which is way higher than what a lot of people would get. For example, if they put their money in a bank account or the RSA retail savings bonds. And those also don't go up with inflation, and actually when interest rates go down, they might go down. So it's a very difficult situation Anne's in, but it actually doesn't sound like she's ended up in the worst situation. I think it's probably making the best of a very tough situation.
Okay, no, that does make sense. All right, to Kim's question, I'm in my 60s. I have some extra savings I won't need. My adult children have bought homes. They've got young children. Is it a good idea to give them some of the money now? I want to help them. I don't want to run out of money myself. Kim's got an interesting question. Got an interesting problem.
I think it's an amazing thing to do, and there have been studies that have been done about this topic all around the world, including South Africa. And if you've got adult children who are responsible with money and they're not just blowing it, and in this instance, it seems like they've bought houses. That doesn't sound irresponsible to me. Then giving them some capital in while they need it most has a huge impact on their quality of life, their ability to look after their own children, and it almost works out sort of 1 to 2. So giving someone 2 million Rand when you die in your let's say in your age 85 and they're 65, or giving them 500,000 Rand now, it ends up being about the same. So I think giving them the access to the money now makes a lot of sense and will be life changing for them. It also allows you to see the benefit of that money actually really making their lives better, and I think it's very rewarding for parents who are capable of doing that. There is obviously a huge caveat and that is, please don't give away too much and get into the position where you run out of money. So some of the money, especially if it's a loan or a home loan, for example, is the one solution is you can sign a loan agreement with your children to say, I will lend you this money On my death, it will become part of my estate, and then you will inherit it. But in the meantime, I will give it to you as a loan, and my plan is never to draw on that loan unless I run out of money. So you can set up a legal agreement between yourselves and your kids. I think it's a very good idea because you want to be very careful of donations tax. Just as a reminder, you're allowed to make donations of up to 100,000 Rand a year. Anything over that, you start to incur donations tax. So doing this as loans to your children on the basis that you don't expect them to pay it back immediately, and you can give them a fairly friendly interest rate might be better, or you can decide to start actually giving them the money and paying donations tax. That might be an option for some people, but certainly if it's below 100,000, you can donate 100,000 a year, and if Kim's married, her and her husband can both do 100,000 to each child, and that's a very nice way of doing this very efficiently from a tax perspective.
Okay, now that makes a lot of sense. And then very quickly, this is all about time.
You have a superpower, all of us as individuals. We're not tiptoeing around what fund managers and institutions are doing, having to perform and show our results every month or every quarter or every year. We're in this for our lifetimes. And so that means that you don't need to make decisions based on short-term movements or what the boss says. You can do this for yourself. And that gives you a huge advantage over everyone else who's operating from day to day or week to week. So use time as your superpower and focus on the long term, and please ignore the short term.
Warren Ingram, thank you very much indeed. Good advice, especially this evening. Warren, of course, is a co-founder at Galileo Capital and a certified financial planner. He'll be back next week.